Hello and welcome to Econoday Unplugged, Tuesday, 4th of December 2019 already. Mark Pender is stateside, Brian Jackson joins us from Sydney, and I'm Jeremy Hawkins here in London. Not such a rosy start to this week then, with stocks hit hard by President Trump's announcement of new steel tariffs on Argentina and Brazil. As we speak, time is also running out before he has to make up his mind on a threatened fresh round of taxes on China. So for now at least, global trade looks set to remain main driving force behind market behaviour. But then Christmas is coming, so perhaps the spirit of goodwill will prevail in the end. Or not, of course. Inevitably, financial markets will be watching very closely. Anyway, since we have Bram with us this week, one burning question I'm sure we'd all like to ask him is this. We all know that the Aussies like to throw a shrimp on the barbie at any time of the year, but do they stick a turkey on it at Christmas?
Not perhaps in the barbecue, but a lot of people do stick them in the oven, but we have other options as well as available to us. We can actually go out to the barbecue, obviously. So, there's a bit of variety on offer here.
Excellent. Good to know. Right, to market matters then. Let's kick off with Japan. Some fairly sort of horrible numbers, I suppose, last week suggesting that this October tax hike is having an impact. Retail sales, October IP, really looking pretty terrible. I guess that means that a contraction in fourth quarter GDP is all the more likely now. Should we be worried about that? Does it matter for policy?
I don't think it matters hugely. I think if you look at the September data, obviously we had a bit of a surge in a lot of those indicators as people tried to get their spending in before the introduction of the consumption tax at the start of October. So I think that officials will sort of look through some of that month-to-month volatility and just consider the underlying trend in most of those indicators. And if you look at the underlying trend, the economy is not doing fantastic, and there are still some rather subdued numbers in terms of manufacturing and trade as well. But I don't think they're going to be too worried about that 1 month reaction to the consumption tax.
So should we be looking for some kind of decent bounce back in the November numbers?
I think you'll get a bit of a some recovery. That tend to happen whenever you have a one-off move in consumption taxes or other tax rates. So again, just look to the sort of 3 or 4 month average before you make too many big conclusions, I think.
Okay, fair enough. What about Australia then? No change out the RBA yesterday, but clearly they're still talking about downside risks. So presumably we can't really rule out any kind of, at least additional easing of some description there yet.
I think that's right. Bear in mind that the Reserve Bank of Australia always takes a month off at the start of the year in January, so we won't have a meeting for another 2 months now that we had their meeting yesterday. So that will give them a bit of time to see how things are going on the trade front, see if there's any signs that inflation pressures are building more strongly than they expect. But a lot of people are still expecting that when they do come back from the summer break down here at the start of February, that another interest rate cut will be on the agenda. We've also had over the last week or so some comments from the RBA Governor, Philip Lowe, just talking about the potential for them to pick up unconventional monetary policies going forward. So we haven't had quantitative easing here in Australia. They've been able to adjust policy just with the conventional method of lowering interest rates, but we are now getting down to close to zero. It's been at 0.75% now. And so we had the governor last week saying that we still think there's a little bit more room to use interest rates as a policy tool, but if they were to get down to 25 basis points, that's when they would start to consider quantitative easing.
Well, I have a question here, and that is, this is Mark, about, and this goes with the ECB earlier, a couple months back. Was it their deposit rate that they cut by 10 basis points?
That's right.
would they start, that incremental 25 basis points? Could they start instead of doing 25, is 10, basis points, that kind of idea? Do you think that could be a possibility that we'll see with these banks, not just the RBA, but other ones too, where they're running out of room down there? I mean, can it be that we're going to change what an incremental rate cut is?
Yeah, that's definitely an option. And you have seen just recently the Reserve Bank of India, well, they went with 35 basis points. So I don't think people, officials are necessarily committed to the idea of just moving in 25 basis point steps. So you're right, that could be an option if they are still a little bit wary about using these unconventional tools, if they could just go a bit slower with the policy rates.
And we have India. Is it tomorrow? Well, India's on Thursday. Is that right?
Yes, it is. That's right.
Reserve Bank of India. And what do you think?
Well, I think that, again, the bias still is towards lower rates, but we have seen a bit of a pickup in inflation pressures recently. So, much of that, though, is just driven by food prices. So they might look through the food price moves and just try and analyse what the underlying price pressures are. So I think it's definitely on the table for some more policy rate cuts there as well.
Can I just ask you quickly, just going back to Australia? So I saw some of those comments you mentioned, sort of get down to 25 basis points on the official cash rate, then that could mean I start looking at QE. Do you think implicit within that is at this 25 basis point level, is it in terms of interest rates? Or do you think, well, that's when perhaps we'll bring in some form of non-monetary accommodation, but that in itself doesn't rule out the fact we could perhaps see rates going into negative territory?
I think the governor was pretty clear that he didn't want to go into negative territory. So, again, I think that would be definitely the case where they'd start using other tools. Bear in mind also that he's still trying to push the government to do more on the fiscal side.
Right.
The government is still holding on to its commitment to try and get the budget back into surplus this financial year. And they've come under a fair bit of pressure from the RBA and sort of the media to do more on the fiscal front. So, but at the moment, I don't think the RBA wants to go into the sort of uncharted territory by lowering interest rates into negative rates.
Okay. We can't leave your side of the world without a bit on China. I saw was at weekend time, sort of our sort of time, the manufacturing PMI crept a little bit higher again.
Yeah.
Are things starting to look a bit better out there, or the level's still too low that it doesn't really make any difference?
It's been trending high for the last 2 or 3 months. So, it's not, I don't think it's something that we can completely dismiss. But, again, if you look at the level, overall conditions are still pretty subdued across, the Chinese manufacturing sector. And that's, obviously a large part due to the ongoing trade uncertainty that we see. That said, the officials in Beijing have responded by sort of tweaking some of their policy tools to improve liquidity and get banks lending into that sector a bit more. And so I think you're probably seeing a little bit of an impact there, but it's still a long way off where they'd like it to be.
Okay, fair enough. Right, Mr. Pender.
Yeah.
Back from your vacation last week, you were sadly missed.
Yes.
I see Mr. Trump has been making it more noise that the Fed should do something about dollar strength, which I'm not sure if that really matters that much or not. But obviously what does matter a great deal is Friday's employment report. Mm-hmm. Any thoughts on that, please?
Well, there's going to be a bounce back effect is what is expected from the GM strike. The Econoday consensus here is 180,000 non-farm payroll growth versus 128 in October. So we're going to probably see, coming back to where we were trending before this, the interruption in the auto sector, the unemployment rate is unchanged at a very, very low 3.6%. That's the expectation. And just nothing really significant with wage pressures, very small 0.3% versus 0.2% in the prior month, increase on a monthly basis, but the year on year is still seen at 3%, which is it's not subdued, but it's somewhere between modest and moderate. If there is a a significant breakdown in this report, and we don't see what we expect on the downside, well, that could lift expectations for an FOMC rate action in the following week, which it's not really expected, but it could definitely be on the table. I think the Fed, they stepped back, they went into neutral at their meeting in October, and they probably want to stay that way. But the employment reports are too big and too important, and can make changes for their plans.
Do you think all this pressure coming out of the White House would make them, at least at the margin, that much less inclined to come out and do anything further with rates?
Boy, that's a hard call. But let's look at the history of what's been going on here for the last year or so. So Donald Trump started jawboning the Fed last year. That's while they were raising rates. So they didn't stop raising rates. They had already telegraphed that actually under Janet Yellen. So they just kind of went through with what they had planned. But then at the beginning, after a full year of jawboning, then they started coming into accommodation. 3 rate cuts in a row now. Does that, so at first there was resistance, immediate resistance, you could say. And then, although the Fed tries to work on not the day-to-day market, day-to-day thing that we do or that the markets do, they try to extend time. So, they're cutting rates. Does that mean appeasement? Does that mean that they're, reacting to the administration? But we have to realize that the Federal Reserve is not as powerful as the executive branch. They, however much they would appear to be, or they can print money without authority or without any, authorization from elected officials, but they are subject to political pressures, and they're subject to reappointments, and they're subject to possibilities. Because remember, last year we were talking about Trump was talking about demoting or firing, or these were the things that we're talking that were in the discussion, things that had never been really discussed before. So it's the central bank is a central authority, a central feature, but it is the play. There's a play that's there that maybe that they're sensitive to. They certainly haven't thrown it in their face or thrown it in the president's face, saying, we're not going to do what you're suggesting or what you're pushing for. They step back and go into neutral, and they kind of, let's face it, they hide behind their empiricism and their definitions and their plans, and they talk in this almost like the real world isn't actually there. So they can be close. They actually say they don't even discuss it in their policy meetings in the boardroom. I mean, is that possible? I don't know. But they must talk about it coming into the boardroom and going out of the boardroom, right? So it's its own little world, I think, and it's hard to say whether or not they're. But the Federal Reserve was born out of controversy and born out of struggle 100 years ago, and it's been that way through. It was that way through the Depression. It was that way with Volcker, and then with Bernanke doing the quantitative easing. Oh, before I forget, I have a question, Jeremy. Now, the ECB was going to ramp back up QE last month. Is there any? Is that right? And did they do it?
Well, yes, that's right. QE has started. According to the numbers we have out so far, they bought net purchases of just over 20 billion in November. Their average monthly target is 20 billion euros. So it looks like they started. They're off and running again. And of course, as we know from the previous communiques, there's no official end to this quantitative easing program now. It's open-ended, and it'll only finish when the ECB believes believes that it's done whatever it's necessary to actually get inflation back up towards 2%. And I suppose, have you finished on your side with the States? Because if so, I'll move on to Europe.
Yes. Well, let me. I think I'm finished. Let me.
Actually, before you finish, sorry, so I can just interrupt before you do finish.
Ahead.
Before you get off too quick. I see we got the international trade figures out Thursday. Given the focus on global trade at the moment, anything of any interest we should be looking at there?
Well, it's as you know, the what we're seeing now is contraction on both imports and exports, but the actual trade balance itself. It's actually moving within a normal pattern. Sometimes it's up and sometimes it's down. But behind the scenes, there's a contraction of trade on both sides, on both imports and exports. That's the curious thing that we're seeing. So it's hasn't really weighed yet immediately on GDP, for instance. But how long can this go on? What this is a shortage of goods. Right? There's less goods around. I guess there was such a giant surplus of goods that it hasn't had an inflationary effect yet, and it hasn't had a ramping up of domestic manufacturing yet. But the more you put tariffs on other people or on other countries, these are goods and services that have to be either not used or they have to be replaced, and we haven't seen that replacement demand. Certainly, the manufacturing sector is struggling, even though we've seen, like you were talking about in China, the PMIs and elsewhere, that there seems to be a lack or an easing in the deterioration. Now it's kind of stable, but we could see that deterioration resume and actually get. We're speaking of deterioration. What about now? The Swiss National Bank has a meeting. Is that right, next week, or is it this week?
It does indeed. It's a sort of big Thursday next week. We'll have both the Swiss National Bank and the ECB meeting as well. So
are there any expectations that they're going to, if they can't cut rates because they're already in negative territory, are there expectations that they're going to increase stimulus somehow?
Well, I think the expectation at the moment is that as far as certainly the ECB is almost done deal. They won't be doing anything. Their policy is set for the time being. With regards to the Swiss National Bank, you've got to say, yes, there's a possibility they could come out, and if they were to do anything, I think they'll probably cut interest rates further into negative territory. So their policy rate, as they call it, is a minus 0.75% at the moment. They could, in theory, perhaps take that down as low as 1%.
Is there anybody lower than that? Are they the lowest?
No, I think that's just about it, if my memory serves me correctly. But of course, the problem for the Swiss National Bank is that interest rate levels don't always have that much impact upon the Swiss franc, because they've been working with negative interest rates. The deposit rate has been in negative territory for the best part, 3-4 years now, and yet the Swiss franc is still so strong within Europe. But I think just in terms of next week's meeting, the good news for them is looking at their key FX rate, which for them is Swiss franc versus the euro. Well, the Swiss franc's really no stronger against the euro now than it was at the time of the last MPA meeting back in 3 months ago. And at the same time, inflation, although it's still nowhere near where they want it to be, we had some numbers out this week, indeed earlier on this morning, which showed a slight uptick in inflation. So, for the time being, I guess we can say the immediate pressure on the SNB to come out and do anything additional has probably gone out the window. But that said, were something to happen from international trade or comments or political uncertainty which drove the Swiss franc significantly higher, then you've got to think they'll come out and do something again.
But for the Swiss, employment is solid, right? And how's your GDP doing?
On the whole, one of the interesting things is on the Swiss National Bank's standard argument is that the Swiss franc is too strong. They will no doubt next week again reiterate the view that it's overvalued, or at least highly valued. And they've been towing that line for an awful long time now. However, when you look at the national accounts, well, the overall Swiss economy is doing okay. In the second quarter, quarterly growth in Swiss GDP was 0.3%. So that's just on a quarter-on-quarter basis. So that's better than the Eurozone. In the fourth quarter, it came in at 0.4% on a quarter. Third quarter, it's 0.4%. 2% quarter on quarter. So again, that's better than the Eurozone average. And interestingly, most of the growth in the fourth quarter came out of a big increase in exports. So if you look at the contribution of net exports to Swiss growth, it's been significantly positive over the last couple of quarters. And that's during a period when the Swiss franc has been particularly strong. So there are some, I think, at least semi-legitimate arguments to the effect that, yes, the Swiss franc looks to be strong historically, but it's not really had that much impact upon what's going on with Swiss real GDP growth. So I think really from that angle alone, you can say, well, do they need to cut interest rates any further anyway? Okay, quickly then the rest of Europe, I should just pull in some of the numbers from the Eurozone. I guess the only one which has suggested any kind of possible change from this sort of sluggish growth, weak inflation environment we've had for so long was a surprise in the flash November inflation report. That showed core inflation jumping up to 1.3% in November from 1.1% in the final October print. Now that equals its highest reading since October 2015. Certainly wasn't expected. And of course, the question now is this just a one-off blip, which for choice would be my guess, or is it finally the start of a sort of a change in trend that the central bank's been hoping for so long?
What country is this? I'm sorry, what country is this?
This is the Eurozone. So this is overall Eurozone inflation we had out last week. Now, let's say if this is the start of a trend, then all of a sudden it means that the idea of any additional ECB easing pretty well goes out the window. If it turns out it goes back down again in December and January, then pretty well we're back to square one. But what we can say going into next week's ECB meeting is that because inflation, or core inflation I should say, has moved up, those members of the council who weren't at all happy about the ECB's decision to cut interest rates and reinstitute quantitative easing at the September meeting are not going to be particularly happy at the start of next week's meeting either. UK-wise, obviously, we're just over a week away now from the 12th of December election that nobody really wants. Not really too much more to say on that at the moment, bar the fact for what they're worth. The opinion polls currently suggest that the Conservatives have a comfortable percentage majority. They're still running at around about 42%. The main opposition party, Labour, on 31%, Liberal Democrats 14%, and the Brexit Party 4%. Whether these polls are going to be accurate or not, no one's got any idea. But it may or it may not be worth mentioning that something which certainly gave the pound a lift last week was that the only poll that successfully forecast a hung parliament back in 2017, when Theresa May was expecting to walk that election quite comfortably. So the only poll that forecast a hung parliament currently shows the Conservatives taking 359 seats, which would give them an outright majority of 68, which essentially would give Boris Johnson the opportunity to do whatever he wants in terms of government policy. So that would almost guarantee Brexit happens at the end of January next year, indeed, if not even sooner. And then the question mark comes about what the heck happens with regards to a trade deal thereafter. But anyway, that's just where the polls are currently, and you either believe them or you don't.
Well, if the Conservatives get that, is that a sell the pound?
This is the interesting one. I've been trying to go through this my own brain. I mean, what we can say without any shred of a doubt, I think, is if we were to see a fairly sizable Labour majority, the pound would be hit significantly. Although a Labour win would increase the chances of a soft Brexit, or indeed, because they're prepared to hold a second referendum, even stopping the entire Brexit process. If you like, the anti-industry nationalisation policies and so on that the Labour Party has committed itself to in the manifesto would be received like a lead balloon amongst international and UK investors. So we would see the pound come off sharply.
So that would overshadow the effect of Brexit?
It would. It would. I mean, at the end of the day, I think, domestic economic policy has to go on. Brexit's going to happen or it isn't. But, policy, if Labour were to win comfortably, it's going to be here for the next 5 years. If Boris Johnson were to win, I think it really kind of comes down to the size of the majority. If he was to get a huge majority and actually led to investors starting to speculate, well, OK, that pretty well guarantees Brexit at the end of January. But because he's not particularly pro-EU, it's worth remembering, all we've got so far is a deal agreed between Boris Johnson and the rest of the EU about the UK's withdrawal from the European Union. It says nothing at all about what's going to happen to future trade relationships. That has to be agreed between, well, effectively from now until the end of next year, which most people regard as not being long enough anyway. So the danger then becomes that since Boris Johnson appears to be more interested in seeking trade deals elsewhere, we could end up by the end of 2020 with what amounts to a hard Brexit. So, I mean, answering your question starts becoming, quite complicated. Traditionally, a Tory majority, a Conservative majority, is good news for the pound and good news for the stock market. In this particular case, I think were it to be a large Conservative majority, we may actually see the pound rally initially and then start coming off again. I think the stock market may perhaps do a little bit better. But I think, investors will, in some ways, until this Brexit, the whole picture is sorted out, it's going to be difficult for investors to really make their minds up which way to go. Okay, since we are in danger of running a little bit over schedule here, let me quickly just round off with other central bank stuff. Bank of Canada yesterday. Bank of Canada upcoming on Wednesday. Expectations there on the whole for no change in policy. There is certainly, I suppose, a minority out there which believes that the Bank of Canada could come out and cut interest rates. But looking at the latest GDP figures for the third quarter, don't look too great at only 0.3% quarter on quarter. That's 1.3% is an annualized rate. But the slowdown really was just on the fall in exports. If you look at final domestic demand, that was up 0.8%. So the domestic economy was actually doing quite well. So chances are Bank of Canada on Wednesday, no change, but keep an eye open on them because there's still a possibility they may do something. Right. Anyone else for anything else? Have we covered the world?
I think we've done a pretty good job there.
Good. That's what we like to hear. Okay, that's it then for today. Thanks as always for listening from Mark, Brian and myself. Do keep an eye on Global's economic calendar to make sure you're fully up to date with the latest key market moving data and events. And we'll be back again next week. Bye for now.